Greetings from Macau. As a candidate for MBA in Finance and Sustainability, I am here to present the final assessment for Sustainable Finance module. My name is Mary Mendoza with student number 2319446. In this presentation, I will concentrate on ESG for ETF investing. The 7 elements I'll be discussing are important for sound, ethical, and profitable decision making. We will explore ESG strategy for investing and examine how these strategies can enable investors to pursue both financial return and positive societal impact. ESG refers to an investment approach that takes into account a company's environmental, social, and governance factors in conjunction with its financial performance. Environmental elements include climate change, water depletion, and pollution. Social factors involve things such as companies' working conditions, health and safety, employee relations, while governance looks at executive pay, bribery and corruption, board diversity, transparency, among others. Ethical investing continues to gain momentum within capital markets. Investors have various options to engage in ESG sector, including purchasing of shares of specific companies, as well as investing in mutual funds and exchange-traded funds or ETFs, investing in a diverse range of ESG-compliant stocks. In this presentation, we will focus on ETF investing. So why ESG strategies are a crucial part of asset allocation? Let's take a look. Financial providers help investors mobilize their capital towards a more sustainable world. 85% of consumers' choices are based on sustainable products. 1 in 5 of the 2,000 largest publicly listed companies have committed to less or zero emission by 2050. ESG ETF-specific financial products have grown, reaching a record $480 billion in assets under management in 2023. Sustainable strategies are crucial in asset allocation because they integrate ESG factors into investing decisions, leading to a more responsible and ethical investing. Dr. David Costa's books on Money.ai explains that exchange-traded funds mirror indices that are traded on stock exchange and offer advantages like diversification, transparency, liquidity, flexibility, and lower expenses. ETFs are accessible to all investors. For asset allocation profiles, you can see 5 strategies with different investment horizons and asset allocations. Each is analyzed and tailored to investors' goals, highlighting the dynamic profile, a 7 to 10 plus years horizon, which I'll explain in the upcoming portfolio presentation. There are also a variety of asset classes as shown here. Example, equity, fixed income, and much more. Investing in sustainability-aligned companies through ETFs involves selecting funds that adhere to ESG criteria. Here are examples of companies from my portfolio. Financial institutions that offer ESG ratings and scoring systems make it easier to identify ESG-friendly investments. MSCI, for instance, rates over 8,500 companies based on their adherence to ESG standards, providing valuable insights into a company's sustainability efforts. PAB, CTB, SFDR are the most recognizable metrics in the selection of sustainability-aligned companies. Let's take a look at the sustainability ETF portfolio I have curated. Dynamic portfolio is 7 to 10 plus years investment strategy, leveraging core index-based ETFs, namely stocks 60%, bonds 30%, and while thematic satellite ETFs are gold 5% and real estate 5%. My emphasis is on ESG and future growth sectors, aiming for sustainable long-term capital growth with a core and satellite approach. The investment strategy in the satellite allocation employs a diversified and sustainable approach, focusing on U.S., European, and global markets. U.S. exposure is achieved through ARK, AI and Robotics ETF. This equity is invested in companies expected to benefit from the increased adaptation and utilization of AI robotics technologies. European exposure includes Stocks Europe 600 Paris Aligned, UBS Gender Equality, and Franklin Sustainable Euro Green Bond, while global coverage is through Franklin Catholic Principles Emerging Markets Sovereign Debt, OG ESG Gold Mining, and iShares Global Real Estate Environment Tilt. These ETF balance robust ESG principles with long-term financial returns. These 7 selected ETFs adhere to SFDR Article 9 and mostly Article 8 guidelines, aligning our investments with commitment to ESG principles. These ETFs primarily rank between BBB and AA on MSCI ESG scale, providing a robust framework for sustainability while aiming for long-term financial returns. By combining actively managed and passively managed ETFs, this portfolio benefits from diversification, cost efficiency, and flexibility. This approach captures the potential of outperforming active management in specialized sectors such as technology and artificial intelligence, while maintaining stability and broad market exposure of passive investments. So, what's driving the ESG strategy for ETF investing? Quoting Larry Fink, society is demanding that companies, both public and private, serve a social purpose. To prosper over time, every company must not only deliver financial performance, but also show how it makes a positive contribution to society. ESG has influenced both corporate behavior and investors' preferences. Like in every investment, there are risks and rewards. BNP Paribas Asset Management stated that ESG ETF advantages outweighs the disadvantages. ESG has significantly shaped the actions of corporations and choices of investors and consumers. This emphasis on sustainability draws in investors who are keen on fostering long-term value and making a positive difference in society, resulting in a surge of capital directed towards companies with ESG strong initiatives. Data suggests that ESG ETFs may exceed $500 billion by 2030, given the surge in sustainable investing, along with regulatory changes and shift in investors' behavior. We are approaching a pivotal moment for ESG products. This resulted in non-ESG aligned investments being undervalued due to adverse impact, enabling the ESG market to grow faster than anticipated. My ESG ETF selection criteria were based on meeting my goals of capital growth, stability, and less volatility. Reviewing of key information documents allowed me to check the past performance of ETFs. It allowed me to check the TER, potential returns, risk and rewards, above all, the criteria to be able to filter ETFs that comply with Paris-aligned benchmark, carbon transition benchmark, Article 8 and Article 9 SFDR. In conclusion, ESG investing is important not only for investors' wealth preservation or growth, but also to support the companies with ESG in mind, to protect our planet and care for society while making a profit. ETF investing is an effective way to increase wealth with a lower entry level of capital, lower TER, having access to diversified top-performing companies while putting our money to work. The focus on sustainability attracts investors who prioritize long-term value creation and positive societal impact. This is Mary Mendoza, student at Robert Kennedy College. Thank you for the opportunity to present.